Welcome to your weekly outlook. This week, markets appear steady, but beneath the surface, geopolitical tensions and economic uncertainty are creating powerful undercurrents. The recent U.S. airstrikes in Iran sent shockwaves through global markets, reminding us how quickly stability can unravel. Investors now face tough questions. Is this a contained event or the start of something bigger? How will it impact energy prices and inflation? To make sense of it all, we'll connect the dots between global events and market moves, from oil and gold to central bank decisions. Our goal: give you a clear map for the week ahead, breaking down key events and risks across the US, Canada, Europe, and Asia. In a world where a shock in one region can ripple everywhere, understanding these connections is crucial. By the end, you'll be better prepared to navigate the risks and opportunities ahead. The U.S. airstrikes in Iran immediately sent oil prices soaring as markets braced for supply disruptions in the critical Strait of Hormuz. But after the initial spike, prices quickly retreated. Markets judged the conflict would likely remain contained. Robust oil production outside OPEC, especially in the U.S., has cushioned the impact, unlike in past decades. Still, major banks warned that a wider conflict could send oil above $150 a barrel, risking global recession and surging inflation. For now, markets are betting on de-escalation, but the risk hasn't vanished. Any new flare-up could send prices higher again. This volatility hits everyone. Higher oil means pricier gas and increased costs for businesses. The oil market swings this week highlight the fragile balance between geopolitical stability and economic health. The story is far from over. Energy markets remain on edge. Stay alert. The next headline could change everything. The price at the pump is a direct reflection of global uncertainty. In uncertain times, investors flock to safety. This week, gold and U.S. government bonds were the big winners. Gold surged to multi-year highs, signaling deep anxiety about inflation, conflict, and financial stability. Buying gold is a hedge against chaos and currency risk, a move investors make when confidence in other assets wanes. U.S. Treasury bonds also saw strong demand, despite America's role in the conflict, because they're still considered the world's safest asset. This demand pushed bond prices up and yields down, lowering borrowing costs and rippling through the economy. The simultaneous rally in gold and bonds is a clear message. Investors are defensive, bracing for more volatility. These moves affect everything from mortgage rates to corporate borrowing. When fear rises, safe havens shine. The world's money is on guard. While oil and gold markets reflect fear, U.S. stocks are sending mixed signals. Risks are real. Conflict could trigger an energy crisis, and stubborn inflation could keep rates high. Yet, many remain optimistic, pointing to a resilient U.S. economy, strong labor market, and solid corporate earnings, especially in tech. The market is split. Tech and AI stocks are thriving, while sectors sensitive to rates and cycles like real estate are lagging. This divergence shows investors are picking winners, not betting on a broad boom. The bullish case depends on contained geopolitical risks and a careful Fed. Any misstep could quickly shift optimism back to fear. In this market, stock selection and caution are key. The Federal Reserve's next move may matter more than any global headline. This week, all eyes are on Chairman Jerome Powell's testimony to Congress and the upcoming core PCE inflation data. The Fed's challenge tames stubborn core inflation without derailing the job market. Powell is expected to stress a data-driven approach. No promises on rate cuts until inflation convincingly cools. Markets have scaled back expectations for rate cuts this year. One or none is now the consensus. A soft inflation reading could revive hopes for cuts, while a hot number would reinforce higher for longer. The Fed's decisions will ripple through stocks, bonds, and beyond. In this environment, every word from Powell counts. The central bank remains the most important player in the game. North of the border, Canada faces its own economic tests. This week's CPI and retail sales data will shape the Bank of Canada's next move on rates. High inflation could keep borrowing costs elevated. A softer reading may support more rate cuts. Trade tensions with the U.S. are rising, with new tariffs a real risk if politics shift. Protectionism threatens both economies, raising costs and disrupting supply chains. Canada's story mirrors the global struggle: central banks fighting inflation, economies reliant on consumers, and political risks looming. What happens in Canada will spill over into the US and beyond. Watch Canadian data closely, it's a key variable this week. To gauge global momentum, watch this week's flood of Purchasing Managers Index PMI data from the US Eurozone and Japan. PMIs offer a real-time snapshot. Above 50 means growth, below 50 signals contraction. Europe's numbers will reveal if its economy is stabilizing or sliding toward recession, with implications for ECB policy. Japan's PMIs will show if its economy is adapting to new policies or facing fresh headwinds. US PMIs, combined with other data, will round out the picture of American business health. Weak PMIs could stoke recession fears. Strong ones would support the case for resilience. Together, these numbers will set the tone for global markets. The world's economic pulse is in the data. Despite calm markets, risks are rising. Think of walking on thin ice. The biggest dangers, a Middle East flare-up, surging oil, and renewed inflation, all of which could force central banks into tough choices. In this environment, complacency is costly. Investors should focus on defense, diversify, favor quality assets, and hold some gold or high-grade bonds. Prioritize companies with strong balance sheets and reliable earnings. Stay alert to geopolitical headlines, inflation data, and global PMIs. They'll shape the next moves. The goal now is capital preservation, not chasing risky returns. Vigilance and flexibility are essential. By staying informed and cautious, you can weather the turbulence ahead. Keep seeking clear analysis to navigate these complex times.